this segment here is all about what different tactical strategies can 7 to 9 figure entrepreneurs use to protect, manage, and grow their wealth. And we talked about the institutional capital, building long-term value. This is going to be all about how real estate families have used a similar playbook, but the buy, borrow, die to build real estate dynasties that can span multiple generations. So this has been a playbook used by the Trumps, Hiltons, Waltons, all of the ultra wealthy. So we got a visual we're going to show that we're going to pop on the screen here, just outlines at a high level, and I'll frame this up, the buy, borrow, die strategy. And so just at a high level, the idea is you buy a piece of real estate, and that's on the front end. But because you've got cost segregation studies, depreciation, etc., you get massive tax benefits. So not only upfront, but also the ongoing ownership of real estate creates massive tax deductions and massive tax savings. Well, the second part of this is borrow. And what that means is that there's multiple avenues in which how you can extract cash out of this type of investment. There's one of the most common ways you'll see is a cash out refinance. So as your property appreciates, as it makes more money, you can do a cash out refinance to take money off the table, and that's tax free. Secondarily is if you want to upgrade your property, you can use 1031 exchanges. So you can tax free essentially sell your property and roll all the proceeds into a new replacement property. And then the die piece, this is the least fun part of the buy, borrow, die strategy. But the idea is that if you're a married couple, you have less than $30 million, or if you're single, have less than $15 million, that's the exemption amount. When you die, the assets you own get a stepped up basis, which essentially means that all of that depreciation I took and all of the appreciation of the property on the day I die, it gets reset to fair market value. So my kids can list the property that I took all these tax deductions with, that increased a bunch in value. They sell it the day after I die, they pay $0 in taxes. So that's the die piece. So that's the frame up on this. Jim, I know we were talking before the camera came on that you had some friends that were just talking to you about the buy, borrow, die, or asking you some questions. So curious to hear your thoughts on that.
Yeah, one thing just to clarify on the die, the 15 and 30 million, that's starting January 1st. It's a little less today, as you know, but just want to clarify that. And then also on the buy, we've talked about this before on the call, but it still comes up all the time, and I hear it all the time, is cost segs, depreciation, massive tax benefits. However, it depends on your situation, whether you can actually utilize those tax benefits. If you're a qualified real estate professional, absolutely. If you're not, it becomes more nuanced than that. And I see all the time and hear all the time entrepreneurs thinking they have an active business, they can just go depreciate real estate, and it offsets their active income. And you and I know that that is not the case. As far as buy, borrow, and die, first, I agree with you 100%. The die part, I definitely have an issue with. I don't want to. When dying is a good strategy, it's not that exciting to me. But I was talking to some friends the other day about this, and they were really talking about like, hey, is this something that we can do? It absolutely is something that you can do. However, you also want to be aware that this works best with real estate. You can do it with stock portfolios and other things. I also caution that whenever you take loans on anything, there's an interest rate involved. Even if you're paying yourself money back, you have to be aware of that. And you don't want to get upside down and borrow too much, no matter what the strategy is.
Yeah. And I think to back up a little bit, you mentioned the depreciation may not really help you from a tax perspective, and it may not be able to offset your other business income unless you're a qualified real estate professional. So just to clarify, that means 750 hours minimum in a real trader business, and at least 50% of your time must be in real estate. So it's a hard bar for any of our entrepreneurs to climb. So if you're running a business selling widgets online through the TikTok shop, it's going to be very difficult to qualify as a real estate professional and to use the losses that real estate generates to offset this. But that being said, even as a standalone investment, real estate can be very powerful, because if I'm just collecting rent, all of those depreciation losses can offset any of the rental income, assuming I have enough depreciation there. So it is a good tax efficient vehicle, just even as a pure play, standalone, passive investment.
Absolutely. I think what I see is younger entrepreneurs that they hear about this and they think they can buy their first property and then offset all this taxes. And that's not always the case. Sometimes we've seen where entrepreneurs will get the spouse to qualify as a qualified real estate professional. I will say that sometimes I see people fudging numbers and making stuff up. And if you ever get audited, you don't want to be sitting there after you fudged numbers and made stuff up. But that can work if you have a spouse qualify.
Yep. All right. So why is real estate a great vehicle from a wealth transfer perspective? The first thing, which is maybe it is a little bit of a misnomer, is that illiquidity is actually a feature, not a bug, when it comes to multi-generational wealth transfer. Because we know that regardless of what asset class you're in, there's going to be some big downturns. We think of with real estate, you think of really coming out of 08, 09, and really I think things hit the trough in 2010, 2011, but you had the stock market down 40, 50%, you go to the dot-com bubble. But the good thing about real estate is that it's not very easy to sell real estate. And generally, by the time you kind of have a buyer, you go to market, you get it all cleaned up, the market may have recovered. And so one of the things that we see a lot is that second generation, third generation, is that having the ability to quickly sell an asset and let your fear and your behavior really can harm you, because you generally sell at the worst time, right? You sell when the economy gets shut down with COVID, and then you miss the 30% rally that happens right after that. So go through, Jim, a little bit, talk through some experiences you've got of where you see panic selling, and where this illiquidity, if you're trying to use this as a generational wealth transfer vehicle, is a feature.
Let me start with what I see as far as real estate in illiquidity and why that helps so much. When we talk about real estate, the fact that it's hard to know what your real estate is worth can be a huge benefit. And as you said, it's hard to sell. I know exactly what my stock portfolio is worth to the penny at the end of the day, and I know I can sell it all tomorrow by clicking a button. My real estate, I think I know what it's worth. I can go on Zillow for my house, but I really don't know what it's worth, and there's a whole process that takes weeks or months to sell real estate. So those things prevent me from doing something stupid. The other thing that's great about real estate is if you take a stock portfolio, for example, all the costs of that stock portfolio come out of the stock portfolio. Fees, management, all that kind of stuff. With my real estate, all the fees come out of a separate account. I've got my checking account that I'm paying insurance and I'm paying interest payments or mortgages out of a different account. So in my mind, I'm looking at that real estate and I go, I bought it for $500,000. Now it's worth $700,000. I made $200,000. I don't see that I spent a bunch of money on insurance and mortgages and all those other things. So because it's separate, we tend to bucket those things and think our real estate is doing better than it is. And then also with real estate, you can use leverage. Leverage can also kill you on the downside if you over leverage your properties, but they accentuate on the upside your returns. That's why real estate can create great returns. So I see that. And the biggest mistake I've seen with people with their stock portfolios is trying to be smarter than the market, trying to outguess the market, think they know something's coming when they don't really know something's coming, and then they sell and panic. And then when do you get back in? The clients I've seen that have done the best in the stock market, they'll say things like, oh, I haven't really looked at that in like a year. And I'm not suggesting you ignore your stock portfolio, but maybe I am, because the more you look at it, the more you think you're so smart that you can make a decision and decide when to get in or get out is usually problematic. And I've never seen anyone do that successfully over the last 30 years. So those are some of the reasons why real estate can be a great investment.
Yep. All right. Makes sense. So you buy the real estate, you get the depreciation, you get some of these tax deductions and the write-offs. Then, the real estate hopefully goes up in value. Hopefully the rent roll or the income it produces goes up in value. And then you can say, hey, I want to do a cash out refinance. So in that situation, right, I just put a new loan on there. And if my new loan, I can get some tax-free access on that capital. Now, of course, you're only going to do that if the rent roll that you've got is more than enough to offset the higher debt payment. But that's a way to you continually to strip more and more cash out of the property by doing cash out refinances over and over again. So that's a very common strategy to tap into that equity in a tax-free manner. But then, like I mentioned in the beginning, you can also do a 1031 exchange. So if you want to completely upgrade the property, buy something new, you can sell it. You've got to do the 1031 exchange, the 45-day recognition, right? And then the 180-day. And then you got to just make sure you get another investment asset that's very similar in size, and there's different requirements there, but allows you to do a tax-free swap. So that's the other powerful piece of real estate, is that there's a few different ways you can tap into the appreciation, the income, the growth without having to pay a tax bill.
Where do you see QOZs fitting in with this whole strategy?
Well, QOZs would be part of if you recognized some gains, right? You would then roll some of your capital gains, but you would have still your basis that you'd have to figure out something to do with. And so the question would be then, what do you do with the rest of your money? Do you just, move on? And there's a way for you to, it would be another exit vehicle you could do in lieu of a 1031. And that would be maybe a middle ground if you want to take some chips off the table, but then that would just be a deferral, Whereas
Yeah.
a 1031 is a complete eliminate. Well, I guess the 1031 is a deferral because unless you die, eventually when you sell that 1031 property or the property after that, your basis is zero. You're going to have to pay the taxes unless you die.
Yeah. So it doesn't really fit in. It's another alternative, but
Yep.
it's not really the buy, borrow, and die strategy.
Yep.
Sounds like.
Yep. So as we go into the die piece, again, the whole premise here is that when you die, all of the assets in your taxable estate get a stepped up basis, which just means that your original investment amount gets stepped up to fair market value. So your children or your heirs can sell the investment, whether it's real estate or stocks or anything, the day after you die and pay no taxes. But this is only true if it's in your taxable estate, meaning that those assets are not in essentially an irrevocable trust that you've made a completed gift on. And so practically speaking, as you said, this year, $13.99 million, next year, $15 million per person. So if you're a married couple, you multiply that by 2. Now, if you're above that amount, sure, you get a stepped up basis, but you pay estate taxes. So that's where in reality,
40% on the federal level.
Yep.
And then you may have state limits can be much lower.
Exactly. And that's on everything above those thresholds we mentioned. So practically speaking, for these billionaires, you can't do this strategy at mass scale and get both of these approaches. And generally what you're going to do is you're going to want to mitigate the estate tax, because the estate tax at 40% is going to be a bigger bite than paying long-term capital gains or even depreciation recapture. So normally then you're going to move some of this real estate into generational trust or dynastic trust. You're not going to get a stepped up basis, but you're going to avoid the estate taxes. But it makes sense, because if that were me, I would make the same move. I would just keep 1031ing and just keep doing cash out refinances within that irrevocable dynastic trust structure. And as long as I never truly sell without doing a 1031, I don't really care about the stepped up basis, because I'm just going to keep like restripping the equity out through a cash out refinance.
It's interesting when we talk about family offices and where private equity is now having pressure to give more distributions and income, because it used to be just family offices, billionaires who were investing in those types of things. We talked on a previous call where now people like you and I investing in private equity want to get some money out. We don't want to sit it, have it sit there for 30 years. And the same thing's true with the real estate, with these family offices, where they just keep the real estate for generation after generation. And one other thing that we kind of touched on, but that's when you have investments that are easy to sell, you get generations down the line who want to go buy cool stuff and spend it and waste it. And it's much harder if it's in trust. It's much harder if it's real estate as opposed to a stock portfolio or, bonds, something of that nature. And I think of Sam Walton because he was so visionary that he put his company in the 1950s, I believe it was, equal parts between him and his kids. And even recently, I remember after he died, his kids were in the top 5 richest people in the world individually. And now I still think his kids are in the top 20 richest people in the world because he gave away his company to them at such a young age. And that made all the difference.
Yeah. And there's case studies of this, right? You look at the Hilton family, Conrad Hilton, Baron Hilton, right? They've used, different trust structures, different holding companies. The Trump family, Fred Trump, right? He transferred over $1 billion to the children is what it's kind of assumed. Now, obviously, President Donald Trump is a beneficiary of that, using a lot of different grats and partnerships. And then, like you mentioned, the Walton family. So this is definitely again, real estate. When you look at the billionaire allocation, it depends on, exactly what billionaire, but on average, you're going to see around 10 to 30% of the entire allocation in real estate. So it's obviously one of the most important and one of the biggest asset classes that billionaires are allocating their wealth to. Obviously, if you're a Hilton family, if you're a Trump family, it's going to be disproportionate, higher than that, because that was the actual wealth creator. It wasn't a diversifier as the wealth creator. And
as you think of diversification, actually having this into an actual plan, maybe you're giving some of your company's stock to gift trust for the kids or multi-generational, and then you're keeping things like the real estate in your own estate as long as you're below that 15 or 30 million because of the stepped up basis and because of the tax advantages that you don't get when you move them down to a trust for future generations. So there's all of that comes into play as well.